distinguished industry leaders, partners in national building, and esteemed guests, a very good morning to you all. Before I come to this subject, which is very important subject, capital markets, both debt and equity, let me remind ourselves we all owe a big debt, a debt to our armed forces, and we bow our head in gratitude, all of us. Please thank them with a round of applause. Unless we are secure, our economy cannot grow. It's an honor to be here today and share my thoughts on the key growth enablers that can propel India towards the ambitious yet achievable vision of becoming a Viksit Bharat, a developed nation by 2047. As we stand at this pivotal juncture in our economic journey, it's clear that India's transformation will be powered by a convergence of long-term investments, infrastructure expansion, technological innovation, and deep institutional reforms. The government's commitment to building world-class infrastructure, improving ease of doing business, and unleashing entrepreneurial energy has already begun to redefine the contours of our economy. Digital transformation, the emergence of AI, and the strengthening of digital public infrastructure are unlocking efficiencies and inclusion on an unprecedented scale. These developments, combined with strong macroeconomic fundamentals, policy stability, resilient financial market ecosystem, are creating an enabling environment for sustained capital formation and productivity-led growth. While India's banking system continues to play a vital role in credit intermediation, it alone cannot meet the vast and long-term capital requirements of a rapidly growing economy. The scale of investment needed to fund infrastructure, clean energy, innovation, and industrial expansion demands diverse and sustainable sources of financing. Capital markets bridge this gap by offering a platform for equity and debt financing, enabling businesses to access patient capital without over-reliance on debt or collateral. How are the capital markets fueling India's development? Well, the Indian securities market is not merely a facilitator of financial transactions, but a powerful engine of capital formation. Our capital markets have become an essential channel through which domestic savings and foreign investments are directed into productive economic activity. This is helping fuel innovation, entrepreneurship, job creation, and infrastructure development. And the Indian capital market has seen remarkable growth over the past few years. At the cost of repetition, many previous speakers have spoken about a lot of statistics. I would also like to focus on some of them, just to give you the size of the Indian security markets today and what role they can play. Over the past 10 years, around 93 lakh crore has been raised from the capital market through both equity and debt issuances, supporting growth across sectors. Our market has facilitated average equity issuance of around 2.2 lakh crore per annum over the past decade, supporting business expansion and innovation. FY25 marked a record year with 1.7 lakh crore raised through 320 IPOs, the highest number ever, underscoring the growing depth and vibrancy of our equity markets. Market capitalization of listed companies has risen from around 150 lakh crore at the end of FY19 to rupees 423 lakh crore as at the end of April 2025, reflecting strong investor confidence and robust corporate performance. Average daily trading volume have grown significantly from rupees 35,000 crore in FY19 to over 1 lakh crore now, indicating deeper liquidity and broader participation. And let's look at the investor participation itself. The number of unique investors in security market ecosystem has almost tripled since March 2019 to reach over 13 crore now. Of course, demat accounts are much larger, over 19 crores, but unique investors are over 13 crore, signaling the growing trust of retail investors in capital markets. However, there is still a huge potential to expand further. If you just compare the US market and Indian market, the level of retail participation in India is still much lower than US. And in many respects, we are, sort of following the dynamism of US markets. India's population is predominantly young, aspirational, and increasingly financially aware. This demographic dividend presents a unique opportunity to deepen and broaden our capital markets. As per industry estimates, around 1/3 of Gen Z investors are already participating in the securities market, an encouraging sign of growing financial engagement at an early age. This trend reflects not only the rising trust in formal financial systems, but also signals a significant opportunity for long-term wealth creation and inclusive participation in the nation's economic progress. Assets under management. The retail participation in securities market is further reinforced by the growth in mutual fund industry, with asset fund under management increasing from 24 lakh crore at the end of March 2019 to 70 lakh crore as of end of April 2025. Mutual fund SIP flows have been seen steady growth over the years, with annual contributions rising from less than 1 lakh crore in FY19 to 2.9 lakh crore in FY25. As a result, SIP AUM has expanded nearly fivefold, that is from 2.7 lakh crore in March 19 to 14 lakh crore as at end April 2025. Alternative investment funds are playing an increasingly important role in India's journey towards becoming a Viksit Bharat by channelizing long-term capital into high-impact areas such as startups, infrastructure, innovation, and emerging sectors. AIFs are helping to bridge critical funding gaps that traditional sources may not fully address. They support risk-taking, promote entrepreneurship, and enable the development of future-ready sectors, which are the key drivers of a developed economy. The significant growth in AIF investments from 1.1 lakh crore as of March 19 to 5.4 lakh crore as of March 2025, which is 5 times, reflects the growing relevance and potential to catalyze sustainable, inclusive economic growth in the decades ahead. Portfolio management services, PMS, which facilitate long-term investments, have seen their assets under management grow from 2.8 lakh crore in FY19 to 7.2 lakh crore in FY25. We are also witnessing the increasing importance of new investment vehicles such as REITs and InvITs. My previous speakers have also said it before, which are gaining traction and have the potential to significantly support infrastructure and real estate development. These instruments offer long-term investors access to stable income streams while providing infrastructure developers a means to recycle capital and fund new projects, thereby accelerating India's core sector growth. At present, we have 6 REITs and 26 InvITs registered with SEBI, signifying the potential to mobilize long-term capital. REITs and InvITs have mobilized 1.5 lakh crore over the last 5 years. Let me come to the foreign investments, FPIs. As regards foreign investment, the long-term trend of foreign portfolio investments in India remains strong. The equity assets under custody of FPI has increased from 21 lakh crore in FY15 to 69 lakh crore as at end April 25, representing around 17% ownership in Indian listed companies. Reinforcing sustained global confidence in India's growth story, India's share in the MSCI Emerging Market Index has risen significantly from less than 9% a decade back to 19.2% as at end of April 25, highlighting the country's growing weight in global portfolios. What's the SEBI's role in enabling how do we enable markets? And I think at SEBI we recognize that for capital markets to remain a driver of growth, we must continue to foster trust, innovation and accessibility. Our focus remains on promoting ease of doing business in the securities market through regulatory simplification, faster approvals and technology-driven oversight. We are committed to a framework of optimum regulation, one that ensures investor protection while allowing businesses to innovate and thrive. Some of the building blocks. SEBI has taken various measures to create building blocks to facilitate capital formation and prepare the market ecosystem which is resilient and future ready. Some of these measures are reduction in timeline of shares in public issue from 3.6 to 3.3 working days. Fast tracking of the right issue process, easing on the onboarding process of FPIs, introduction of MF Lite framework, upstreaming of clients' funds to CCs, that means clearing corporations, to ensure client funds are protected, strengthening the governance of MIIs, two of the leading MIIs, their heads are sitting over here, strengthening of corporate governance for listed companies, and that's very important too. SEBI remains committed to fostering innovation and expanding the product landscape to support the dynamic needs of a growing economy. In this direction, the recent initiative includes granting in-principle approval for electricity derivatives, a potential tool to hedge against the volatility in energy sector. Further, to provide more flexibility to the investors and bridge the gap between mutual funds and PMS, we have introduced a new asset class which is specialized investment fund. Let me state something about strengthening debt markets, which are generally, not being talked about. Our emphasis always has been on equity markets, but traditionally, in many markets abroad, debt markets are much larger than even equity markets. We do have a GSEC sector, the government bond market, but I'm talking of here the corporate bond market and the market which the SEBI regulates. Over a period of time, SEBI has taken several steps to strengthen the corporate bond market architecture. For instance, earlier issues of private placements were usually negotiated by the issuers directly with investors or through arrangers. The process was time-consuming and inefficient. Introduction of electronic book provider platform, which is EBP platform, addressed these issues and led to increased efficiency and better price discovery. In order to streamline the issuance process, improve transparency and liquidity in the corporate debt bond market, we have taken continuous measures. Recently, we have expanded the scope of EBP platform to include issuance by REITs and InvITs as well. Now the electronic book mechanism has been made mandatory for the debt issuances of 20 crore or above, which was earlier 50 crore. These measures would further streamline the debt issuance and broaden the overall debt market. The request for quote, which is RFQ, and online bond platform providers, OBPP, are facilitating improved price discovery and secondary market activity. These initiatives have made fixed income investments more accessible to institutional as well as retail investors. As a result, the total number of clients registered in the OBP segment have now increased from 3.5 lakh in FY24 to 5.6 lakh in FY25. Further, the value of trades in corporate bonds through RFQ platform has gone up by 55% to 5.3 lakh crore in FY25 from 3.4 lakh crore the previous year. Additionally, the Limited Purpose Clearing Corporation, which is LPCC, is gaining traction by enabling a robust framework for repo transactions in corporate bonds and ensuring better clearing and settlement mechanism. In March 2025, trade volumes of LPCC has increased to over 35,000 crore from modest beginning of rupees 480 crore in July 2023. Let me say something about municipal bonds as well. Municipal bond market is nascent but has a huge potential. India is undergoing rapid development and urbanization, leading to growing demand for robust urban infrastructure. The municipal bond market offers a viable means to urban local bodies to raise funds from the capital market. To create a more diversified capital market ecosystem and to strengthen urban infrastructure, we are encouraging capital raising through municipal bonds. Since 2017, municipalities across India have collectively raised about rupees 2,784 crore from 17 issues. These include bonds issuance by municipal corporations of cities like Indore, Pimpri, Ahmedabad, Vadodara and Rajkot in the last couple of years. Municipal bond market in India is still at a nascent stage, but holds immense potential for fundraising and broader participation by the market players. With the active participation, it can become a key source of financing for urban infrastructure. I'll speak something about technology now. The technology is playing a pivotal role in reshaping the capital markets. It enhances efficiency, reduces compliance cost, and improves investor experience. Market participants must proactively adopt technology-driven solutions to strengthen internal processes and risk management frameworks. On the regulatory front, technology is a powerful enabler in strengthening surveillance, enhancing supervisory effectiveness, and minimizing market misconduct. A future-ready capital market must be built on the foundation of innovation, transparency, and responsible use of technology. Today, we as a jurisdiction are recognized worldwide as a pioneer in adopting technology-driven market solutions and supervisory tools. We call them SupTech, setting benchmark for regulatory effectiveness globally. In securities market ecosystem, we are focusing on optimum regulation. We intend to simplify regulations, remove redundant provisions, and facilitate ease of compliance, while ensuring high market integrity and robust investor protection. To achieve these objectives, we need support from the industry as a trusted partner. As we look to the future, the path to Viksit Bharat will be shaped by our collective commitment to inclusive, transparent, and growth-oriented financial systems. The capital markets are not just enablers, they are integral to this transformation. I urge industry leaders present here today to continue building responsible enterprises, uphold the highest standards of governance, and actively contribute to deepening our markets. Together, let us work towards creating a capital market ecosystem that's not only globally competitive, but also aligned with the aspiration of a new India. A Viksit Bharat is within reach, and the security markets will play a defining role in making that vision a reality. Thank you. Jai Hind.
Thank you, Mr. Pandey, for that inspiring address. We look forward to your esteemed presence in the coming times also with us. To conclude the inaugural session, I now first introduce and then invite Ms. Aditi Mittal, Co-Chairperson, National Council on Corporate Bond Market, ASSOCHAM, and Director, AK Group. She is a chartered accountant with a vision to make corporate bond markets more vibrant and accessible. She has been driving strategy and expansion both in India and globally. May I now request Ms. Mittal to please deliver the closing remarks.
Namaste and good morning to all. After such a powerful speech, I'm still reminiscing that speech. So, concluding remarks, I'm going to start by thanking Shri Tuhin Kanta Pandey, Chairperson of the Exchange Board of India, Shri Ashish Kumar Chauhan, Managing Director and CEO, NFC, Shri Sundararaman.